Let's break it down. Big banks and hedge funds are already talking about 2026 like it's tomorrow. A lot of year-ahead outlooks from major investment firms keep circling around the same four ideas. The AI boom, more money going outside the United States, a softer US dollar, and a new world for interest rates and bonds. I'm Imran, a Middle East-based analyst who follows US politics, markets, and global affairs. Let me translate these themes into normal language. Theme number 1, the AI boom. Everybody knows AI stocks have been the rock stars of the last few years. Chip makers, cloud giants, software companies, their charts look like rockets. Many 2026 outlooks say the AI story is still alive, but there's a twist. The easy money phase may be over. The message is basically this. Yes, AI is a long-term revolution, but if everybody is crowded into the same handful of mega-cap names, any disappointment can cause big drops. So, in 2026, a lot of strategists expect the AI theme to spread out, away from just a few headline tech stocks and into older, more boring companies that quietly use AI to become more efficient in healthcare, industry, logistics, finance. For a normal investor, that means two things. Don't chase only the loudest names at any price, and remember that AI might show up in boring companies too, not just the ones on every thumbnail. Theme number 2, more money outside the US. For more than a decade, the US market, especially big tech, dominated global returns. Now many outlooks say 2026 could be the year investors finally increase their international exposure. Why? Because valuations in Europe, Asia, and emerging markets often look cheaper than in the US. Because some countries like India, Mexico, and parts of Southeast Asia are getting new factories and new capital as supply chains move. And because if growth improves outside America, those markets may have more room to run. From outside the US, this makes complete sense. The world is bigger than Wall Street and Silicon Valley. For an American viewer, the message is simple. If your portfolio is basically US tech and nothing else, you might be missing a big part of the global story. Theme number 3, a softer US dollar. Many forecasts expect the dollar to be weaker in 2026 compared to its recent peaks. Part of that is because the Federal Reserve is expected to cut interest rates more, while other central banks catch up or even stay tighter. A weaker dollar usually means foreign stocks and bonds look more attractive, commodities like gold and some metals can get a boost, and emerging market assets, which often suffer when the dollar is strong, may finally get some relief. From my side of the world, a softer dollar can also mean lower pressure on imported prices and on debt payments in many developing countries. So this isn't just a trading story. It affects governments, companies, and consumers far beyond the US. Theme number 4, a new world for interest rates and bonds. For years, money was basically free. Then inflation hit and central banks cranked rates up. Now we're somewhere in between. Rates may come down, but many strategists think we won't go back to the ultra-zero world we had before. That creates a different landscape. Cash and bonds start to look interesting again because they actually pay something. But higher real rates and big government deficits could mean more volatility and more selective opportunities in both stocks and bonds. For ordinary people, this shows up as mortgage rates that are still higher than what we were used to, credit card and loan costs that don't magically disappear, but also savings accounts and fixed income products that finally pay more than almost zero. So let's break it down one last time. Many 2026 outlooks are circling around the same four ideas. AI is still powerful, but investors need to be smarter about where they get their exposure. Portfolios may finally start looking more global, not just US only. A weaker dollar could shift power and opportunities toward other regions, and we are now living in a world where interest rates matter again, for both borrowers and savers. If you invest, even a little, how are you preparing for this? Are you still all in on US megatech, or are you starting to think more globally? This is Imran Breaks It Down, and we'll keep breaking it down together.